Hey everybody, thanks for tuning in to our quarterly investment review for the Counsel Growth Portfolio. My name is Arnold Machel. I'm the founder here at VisionVest Financial, and you're probably tuning into this because you got an email from us saying this is your core holding, but it's also possible you're somebody brand new just checking out the portfolio or checking us out. We're going to give you an update. Some of the slides are as at the end of March, but I'm going to give you more updated information up until current. So if you're invested in this portfolio right off the bat, just want to point out you're a growth-oriented investor. You want a bit of capital protection, but you're more about growth. The other thing I want to focus on here is this is more of a portfolio than it is a fund. It's classified as a fund, but it really is a portfolio of 17 different funds. We're going to highlight and talk in a little bit more detail about two of those, the Global Trend Strategy managed by Mount Lucas and the U.S. Growth Portfolio managed by Morisco there. I will do just a slightly deeper look into those. This portfolio, its target is 20% fixed income, but in reality it's been closer to 30, 35, 30 maybe right now, and it was as high as 34, I guess, actually, throughout the peak of the market crisis. And we'll delve into that a little bit deeper as well. Oh, by the way, we have audio casts available for many of these individual managers. So again, every single line item that you see here, TSW or Scientific Beta, they are, each one of them are a manager in and of themselves, and many of them provide audio casts to us, many of which are available to the end consumer. So if it's something that you'd be interested in hearing, or if you just want to talk to us about any niche piece here, we'd love to chat with you about that. Just give us a shout. Always love talking about it. We can send you the audio cast, or we can talk about it. So this portfolio dropped 5.11% January to, now this is to the end of March. Things are better now. Currently, it's right now it's down about 9.33%. In contrast to the Dow, which was down 23% during the same down to the end of March period. So a drop of 15 versus 23, much better, particularly for a portfolio that is designed to capture most of the growth in the market. Again, it's only down 9.33 now. It's clawing its way back, but we'll get there in time. We'll show you some stats on that as well. What I really want to focus on here on this slide, though, is on the right-hand side. What can you expect out of this portfolio? And that's represented in this graph here over a 1-year or over a 10-year time frame, what you can expect. And then you see the actual percentage numbers down here of what's that. So what that's telling you is this bright green, this square right here, that corresponds with these figures right here. Most of the time, so your most probable rate of return, most of the time, 70% of the time, over a 1-year period, we would expect that you would earn between a minus 5.9 and a plus 17.5. Now I should point out these are gross of advisory fees. So whatever your advisory fee is, you got to drop, take that off to see what you would expect to get. So call it 1.5%. That's the expected return that you would get there. The broader range, so 70% of the time, it's going to fall within that most probable range, but 30% of the time, so about once every 4 or 5 years, it's reasonable to expect the portfolio to range outside that. And that's what you see right here. Once every 4 or 5 years, we would expect it to drop by more than a quarter, or maybe go up by 36%, right? So more volatile fund than a balanced fund, but not quite as volatile as an all equity fund. 1 year, most of us can live with that kind of thing, but what does it mean long term? What can we expect out of this in the long term? So broadly speaking, we really expect it's going to range in the plus 4.3 to 10.4% range, but likely, actually most probably, between the 5.1 and 8.4 range. So you can see there, basically we're expecting in the neighborhood of about 7%, give or take, out of this portfolio. And so essentially getting a decent rate of return, but without taking on any undue risk. That's what this portfolio is about. So it is, the asset mix is 80%, or the target, 80% equity, 20% fixed income. As I said, that 20% is closer to 30 to 34 it has been in the last little bit. And that's because this global trend, one of those managers that I talked about earlier, they represent 14% of this portfolio. And initially going into the crisis, they were light to U.S. bonds. They had about 11%. Now the global trend is an unusual type of fund. It's got the flexibility to go virtually almost wherever it wants, and so they were not very heavy to U.S. bonds, but they moved more almost to 100% bonds during the peak of the crisis. Settled it down mid-April to 78%, and right now they're sitting around. To 87% in mid-April. Right now they're sitting around 78%. So they are slowly reducing their bond exposure as they see markets settling down. The other thing that did help us throughout the decline was the hedge against currency. Throughout the more volatile time period, they hedged the US dollar by 50%, and right now actually it's zero, basically indicating that they believe that the Canadian dollar is going to decline. And so we want no hedging because that'll help the portfolio. So what helped? Well, fixed income, like we talked about. One surprise sector was the U.S. growth. That's one of the other managers that I mentioned there, Morisco. At first it was a surprise, but then once we drilled into what's actually held inside that portfolio or that component, it made a bit more sense. So Amazon, Microsoft, these are all companies that are benefiting during this COVID-19 crisis, benefiting from people staying at home, buying stuff online, and likely benefiting long-term because the barrier's been broken for many people. There are people that would never have shopped online have seen that it's not that bad, and will likely, maybe not at the same pace, but will likely continue to do some shopping online. Same with Microsoft, whether it's the use of Teams for meetings, which is like Zoom, or the platform that I'm using to create this video for you right now. It's a Microsoft product, so they're benefiting from this as well. What didn't do well was value. Frankly, value struggled for many years. I would have expected it would have done better, held up better throughout this time period. It didn't. So it was good that we had the growth that did hold up better. Value and growth are the two main styles of investing. There are a few others like momentum or factor. They're the two main ones. And often they zig and zag against each other. Value might do better for a while, then growth might do better for a while. And the last few years we've seen growth do better. Certainly throughout this COVID-19 era, it's done much better. At the end of the day, the most important thing that I can say is the diversification that we had in this portfolio really helped. It helped with the downside protection, and it helped give us some areas that went positive even throughout the downturn. Actually, we'll look at those a few of those sectors. So basically 3 sectors inside this portfolio did well. The rest, and this is just broadly speaking, this was true throughout the entire investment industry. U.S. growth, fixed income, short-term bond, the ones that you see here on the left, they did well. Focus on the green, that's the year-to-date there. You can see also the 3-year numbers, but the green gives you a sense of what happened in the more recent time period. This chart's actually as at the end of April there. What didn't do well, like I said, value, dividend, value. So it didn't matter where the value companies were, US, Canada, international. They were the worst performers. But, you know, just about everything was negative, just a handful of things there that were positive. By having exposure to those, it helped us not go down as much as the market and gave us the runway to do better as things improve. Probably the most important thing that I can tell you is to maintain that long-term perspective. The TSX, this year is looking at, you know, the last 6 times that we had downturns in the TSX, big ones, going back to 1957, each drops of greater than 21%. You can see here, 5 years later, we'll just look at this end of the chart for a second here, 5 years later, every single time we had great returns for the following 5 years, ranging from plus 8% a year to as much as 27% a year I don't think that'll be repeated this time, but you never know. We can always hope. So the next 5 years were every single time very good. 5 out of the 6 times were positive, even over the next 12 months. And so there's no guarantee that 12 months from today we're going to be in positive territory, but it's highly likely. Certainly that's been the case in the past. If you're one of our clients, you know how to reach us. If not, you can easily find us on the web or just pick up the phone. Our contact information is right here. Thanks for listening. This has been a VisionVest Digital Discovery webcast brought to you by Arnold Mitchell, VisionVest Financial, and IPC Investment Corporation. Stay safe.
And if I save $1 million, if he saves $1 million, I'll have less to worry about until the day they carry you out. If I save $1 million and reinvest that $1 million, well, I'd buy Arnold lunch. He'd deserve at least a good sandwich. If I'd save $1 million.